Investing is crucial for building wealth. It's how you make your money work for you. Instead of letting your savings sit idle, investing helps them grow over time. You're essentially buying a piece of a company or an asset with the hope that its value will increase. This can provide financial security and help you achieve your long-term goals, like buying a house or retiring comfortably. However, investing can seem daunting, especially for beginners. There are countless options to choose from, each with its own set of risks and potential rewards. Two popular investment avenues are dividend stocks and exchange-traded funds, or ETFs. Both offer unique advantages, and understanding their nuances is key to making informed investment decisions. Dividend stocks represent ownership in companies that distribute a portion of their profits to shareholders as dividends. These payouts are typically made quarterly and can provide a steady stream of income for investors. When you own dividend stocks, you're not just relying on the stock's price to increase, you're also benefiting from the company's success through regular cash distributions. Think of it like owning a rental property. The rent you receive is similar to the dividends paid out by a company. Dividend stocks are particularly appealing to income-oriented investors, such as retirees, who seek a consistent cash flow from their investments. However, it's important to note that dividends are not guaranteed. Companies can choose to reduce or eliminate dividends if their financial performance deteriorates. Therefore, it's crucial to research companies thoroughly and assess their dividend sustainability before investing. Exchange-traded funds, or ETFs, offer investors a diversified way to invest in a basket of assets, such as stocks, bonds, or commodities. They trade on stock exchanges like individual stocks, making them highly liquid and easy to buy and sell throughout the trading day. ETFs have gained immense popularity in recent years due to their flexibility, low costs, and ability to provide broad market exposure. Imagine ETFs as a basket of fruits. Instead of buying individual fruits, you're buying the entire basket, which contains a variety of fruits, reducing your risk. ETFs work similarly by spreading your investment across multiple assets, lowering the impact of any single stock or bond on your overall portfolio. They offer a convenient way to diversify your portfolio and reduce risk without having to research and purchase individual securities. One of the most significant advantages of dividend stocks is the potential for regular income. As mentioned earlier, companies paying dividends distribute a portion of their profits to shareholders, typically on a quarterly basis. This steady stream of income can be particularly attractive to investors seeking to supplement their income or create a passive income stream. Moreover, dividend payments can act as a hedge against inflation. As the cost of goods and services rises, the purchasing power of your money decreases. However, dividends can help offset this erosion of purchasing power by providing a stream of income that keeps pace with inflation, or in some cases, even outpaces it. Furthermore, dividend stocks have historically exhibited lower volatility compared to growth stocks, making them a potentially less risky option for risk-averse investors. Section 5. Advantages of ETFs, diversification and flexibility. ETFs offer several compelling advantages, with diversification being one of the most prominent. By investing in an ETF, you gain exposure to a basket of assets, mitigating the risk associated with investing in individual stocks or bonds. This diversification helps cushion your portfolio against market fluctuations and reduces the impact of any single security's poor performance. Another key advantage of ETFs is their flexibility. ETFs are available for a wide range of asset classes, sectors, and investment strategies. Whether you're interested in investing in large-cap stocks, emerging markets, or socially responsible companies, there's likely an ETF that aligns with your investment objectives. This flexibility allows investors to tailor their portfolios to their specific risk tolerance, investment goals, and market outlook. Section 6. Weighing the risks, dividend stocks versus ETFs. While both dividend stocks and ETFs offer potential benefits, it's essential to acknowledge the risks associated with each investment avenue. Dividend stocks, as mentioned earlier, are not guaranteed to maintain their dividend payouts. Companies can face financial difficulties or choose to redirect their profits towards growth initiatives, potentially leading to dividend cuts or eliminations. Furthermore, focusing solely on dividend stocks can lead to a lack of diversification in your portfolio. If the sectors or companies you're invested in experience a downturn, your portfolio could suffer significant losses. ETFs, on the other hand, are subject to market risk. While diversification can mitigate losses, it's important to remember that ETFs are only as good as the underlying assets they hold. If the overall market or a specific sector declines, the value of your ETF investment will likely decrease as well. It's crucial to conduct thorough research on the ETFs you're considering, understanding their holdings, expense ratios, and overall investment strategy. Section 7. Real-world examples, dividend stocks and ETFs in action. To illustrate the concepts discussed, let's look at some real-world examples of dividend stocks and ETFs. Johnson & Johnson, or J&J, is a well-known dividend-paying company with a long history of consistent payouts. The healthcare giant has increased its dividend for over 60 consecutive years, showcasing its commitment to rewarding shareholders. In the ETF realm, the SPDR S&P 500 ETF, or SPY, is a popular choice for investors seeking broad market exposure. This ETF tracks the S&P 500 index, which comprises 500 large-cap U.S. companies, providing investors with a diversified stake in the U.S. stock market. These are just two examples of the numerous dividend stocks and ETFs available to investors. It's crucial to conduct thorough research and consider your individual investment goals and risk tolerance before making any investment decisions. Section 8. Finding the right fit, which investment aligns with your goals. Determining whether dividend stocks or ETFs are the better investment for you depends on your individual circumstances, financial goals, and risk tolerance. Dividend stocks can be an excellent option for investors seeking a steady stream of income, such as retirees or those nearing retirement. They can also be suitable for risk-averse investors looking for potentially less volatile investments compared to growth stocks. ETFs, on the other hand, cater to a broader range of investors due to their flexibility and diversification benefits. They are well suited for investors seeking broad market exposure, specific sector allocation, or exposure to alternative asset classes like commodities or real estate. Ultimately, the best approach is often a combination of both. By incorporating both dividend stocks and ETFs into your portfolio, you can strive for a balance of income generation, growth potential, and risk management. Section 9. In conclusion, making informed investment decisions. Investing is a journey, not a sprint. Whether you choose dividend stocks, ETFs, or a combination of both, the key is to make informed decisions that align with your financial goals and risk tolerance. Thorough research, diversification, and a long-term perspective are essential ingredients for investment success. Remember to regularly review your portfolio and make adjustments as needed to ensure it continues to reflect your evolving financial needs and market conditions. By staying informed, seeking professional advice when needed, and staying disciplined with your investment strategy, you can work towards achieving your financial aspirations and securing your financial well-being.